one, go. Dear ladies and gentlemen, dear investors, on behalf of Bellevue Asset Management, I would like to welcome you to today's update call on BB Entrepreneur Swiss Small and Mid. My name is Sandro Tiziani and I will be your host during the call. It can probably be said somewhat provocatively that Swiss SMEs have withstood the corona crisis. The broad index is now trading in positive territory compared with the start of the year. Nevertheless, the BB Entrepreneur Swiss Small and Mid Fund has performed far more favorably. At plus 14.3%, the strategy outperformed its benchmark by more than 10% in 2020. Is this simply due to the focus on quality, cash flows, and successful business models? Or is there even a secret recipe? I am very happy to welcome Birgitte Olsen, Lead Portfolio Manager of the BB Entrepreneur Swiss Small and Mid Fund. In the following minutes, she will speak about the current performance and the different phases of the year. She will also show why active management is the key to success in such phases and why we are positive about Swiss small and mid caps. With that, I'd like to hand over to Birgitte.
Thank you, Sandro, for your introductory remarks. I'm happy to update you all on our smallest and newest entrepreneur strategy, the Entrepreneur Swiss Small and Mid, which is the smallest fund, but with a very, starting to build a very good track record. Today, I will focus on performance in the actual market environment and also the positioning of the fund for future performance. If I look backwards and I comment the performance of the fund compared to its benchmark, the SPX Extra, which is the small and mid Swiss benchmark, you can see the strong outperformance of 10% year to date. And if I split this in the different phases, in the first phase, the crisis phase, the COVID outbreak phase, until mid-March, the funds fell, but it fell less far than its benchmark. In the V-shaped recovery phase from mid-March to end of June, the fund performed 34%, which is 540 bips more than its benchmark. And also in the range-bound phase of end of June to end of October, waiting for the vaccine phase, we had 2.6% absolute performance, which was 150 basis points more than the benchmark. And finally, in this fourth phase in which we are today, which is a phase where the market starts pricing in the post-COVID area of 2021 and a strong rebound in November, the fund performed 8.7%, which is 25 bips so far better than the SPI. Now, this leads to the question, how can small and mid caps in Switzerland perform further in this new era post-COVID? If I look at the more short-term charts in the rebound, of course, the SPI Extra plus 45% performed better than the SMI and the Nestlé, but also it fell much more in the shock phase of COVID. Also in the range-bound phase, end of June till end of October, the SPX was stronger than the SMI by the turn of 4 to 5%. And in the fourth phase as well, we've seen Nestlé minus 2%, while the SPX is up 10% month to date. I think it's an interesting phase. We've seen many top-down comments from strategists all over Europe and the US, pleading for a return to value, to a better outperformance of small caps and of more cyclicals. And this is in an environment where value has been a strong loser, and in fact the dichotomy between growth and value in terms of valuation has never been historically as high as today. So big sectors like energy and banks or financials should rebound. In Switzerland, the dichotomy is a bit less pronounced, but still we see that value has strongly outperformed month to date, and we have put some of that in our fund to benefit from this in November. Now, the bigger question is, can this last? Is it just a small firework for 1 month? Does this trend have legs? And probably in an environment where you have a great help from fiscal policy, from investment programs, from monetary policy, you also have much higher political stability, thanks to the new president-elect in the US, the arrival of several vaccines. All of this changes the playing ground for companies. With the wake of COVID, CEOs, CFOs have been busy protecting their liquidity, protecting their cash flows, saving costs, anything, all investments which were not deemed necessary were delayed. And with a better planning stability, we could see this activity reignite. We would expect companies to be ready to invest more again in tomorrow's growth, which means more, also more employment, which also means a higher GDP growth. So we think it's a favorable environment, although we have reached technical resistant levels as we are back to the February levels in the small and mid-cap indices. We think that after a bit of a range-bound period, we should be able to surpass these levels. In terms of competitive performance, I wanted to show you the achievement of the team in terms of stock picking. And I believe this chart really reveals the benefit of an active stock picking, being completely benchmark agnostic, and also in a good control of tracking error, which is more or less around 5. And this produces higher alpha, and I think it also is a characteristic which helps to differentiate ourselves from other funds out there in Switzerland. Now, in terms of Lipper rankings, we are now firmly in the first quartile, which is where we want to be long term, even in the first decile. And we, since we changed the strategy in terms of the construction of the fund, in terms of a core satellite type of exercise with a lower tracking error and an active stock picking in small caps, we have managed to greatly outperform, and we want to continue in that vein. Now, in terms of the positioning, to remind you where we stand in terms of size biased, you see the different size categories of the SPI Extra, the SPIX, the small and mid-cap Swiss index. The category above 20 billion has shrunk somewhat since Partners Group left the index. And you see that we are very invested in small and mid caps, so that a third of the fund more or less is invested in target companies below 2 billion market cap. This is on purpose. We expect great alpha out of this category. The median for our portfolio is actually 3.2 billion. And I think it anchors us at the lower end of small and mid-cap strategies in Switzerland. Second characteristic is the very strong balance sheets we carry in our strategy. It's no different than any entrepreneur strategy, but Swiss companies are even more conservative. You see it also because the benchmark, the SPIX, has a very low leverage with net debt to EBITDA of 0.4, which is a lot lower than European small and mid caps or European and Swiss larger indices. The average of our companies is net cash, so they have tremendous reserves to continue to grow both organically and acquisitory. And actually, these very strong balance sheets are the prerequisites for a continuity in terms of strategy, and even COVID-19 was not a great disruption for the implementation of their strategies, both in terms of innovation and the strive for growth in the niche. So we think it's further an excellent place to be, and actually we would expect in this rebound, in this post-COVID time, we would expect those companies to run faster than the others thanks to the investment they have done in the COVID times. So we expect higher dynamics in terms of earnings and cash flow generation in the coming months and quarters. Innovation is the name of the game, especially in Switzerland, since many of these companies have a very strong cost exposure in Swiss francs, which is very detrimental in terms of Forex. So they need to innovate and they need to be able to implement price increases and to generate a competitive advantage. So we think those Swiss entrepreneur companies are very successful in doing this, and they have been so in the past 30, 40 years in this very detrimental Forex environment. And we would expect this to continue in the coming years as they spend more than average on research and development and earn the fruit of this in higher cash flow and earnings generation. Top 10 today is a bit different than what you see on this slide, because this slide is per end of October. We have now, in this slide, we have one new entrant, which is Inficon. We are very positive on semis. Laurent, which is our tech specialist with an extensive knowledge of the semi sector, has been doing really well in his picks, and our conversation with the management of Inficon and VAT confirmed that these companies are very well positioned with their design wins to benefit from this positive fundamental demand environment of semis in 2021 as well. And I think another catalyst for VAT should come from VAT's Capital Markets Day, which will take place in a few days, where the CEO will certainly comment on the positive environment. We have shaped somewhat our positions in both Logitech and Surrosa. New entrants in the top 10 are Burkhardt Compression and Sulzer, but more to this later. Now, what have we done in those different phases? As you can see, it's been very important to be proactive, and I think the name of the game is really to preempt the next phase. You always have to sort of be ready with your watch lists under the arm, and it's important that the team does its homework before the action starts, meaning that you would have lost a lot of relative performance if you were not ready for the value rebound, which just was staged now in November. The Sulzers, the Burkhardts, and other value companies performed 35, 40, 50% in just a matter of weeks. And we started to put those into the portfolio from August till September, October. So it's really important in stock picking to preempt the next phase. And actually, COVID, as bad as it was an excellent playing field to do that. And the portfolios need a different type of exposures in the different phases, which we have been able to really implement well. The latest additions to the fund, Burkhardt Compression, Sulzer, you see a bit more value than growth at a reasonable price. I think it's reflects also where we see the most interesting risk rewards. Maybe I want to comment a bit more into depth in terms of Burkhardt Compression, a company we've known for a long time. And Burkhardt is traditionally a stock which is very strongly correlated to oil prices. So this month it has been performing really well, in line with a rebounding oil price now that we have promising vaccines for COVID-19. I think it's rebounding for the wrong reason, although it's cheap. I see two catalysts for this stock. One is the fact that they produce compressors not only for the oil industry, but also for the gas and for the Wasserstoff industry, which is in English. It'll come to me in a second, but I'll continue. And as we know, the hydrogen, now it's back to my mind, sorry. The hydrogen production is expected to increase tenfold until 2030. And to transport, store and use hydrogen, you need to liquefy it. So you need a compressor. Burkhardt is one of 4 OEM able to do so, with an excellent set of products out there in the market. So we would expect, we've seen the first sign-ups for Burkhardt in terms of hydrogen projects in the US. The management is very positive that this will be a big trigger for them for the next quarters and years to come. And you can simulate that with their market share, they could, hydrogen could represent 1/3 to 50% of their business in the next 3 to 10 years. This should command a higher rating for the stock. And the second trigger is ESG. The chairman of the board has changed to Ton Büchner. Ton Büchner has a history with Sulzer and also as CEO of AkzoNobel, where he was a very strong driver of sustainability. And we think that like many other companies, Burkhardt has realized they want to work on this, and actually they're better positioned than their rating. MSCI rates them a BBB. Sulzer, for instance, is a AA. We would expect more noise, more positive noise around ESG, as the company is embracing sustainability in a more visible way. This would also lead to higher valuations. If we look at our tech and healthcare exposure, reminding you, as you know, that tech and healthcare were the sacred cows of the crisis, the best running sectors, we are still quite exposed to tech, as it's 22% of the portfolio. These are tech companies or industrials companies with a strong tech exposure, like Huben-Suna or VAT. As a reminder, this is a lot more than the SPIX, because the SPIX is exposed in the order of a magnitude of 10%. I already commented on Inficon and VAT, which we would expect to continue to perform well. And healthcare portfolio is also the same by 12%, but it's always been underweight, and we are now underweight by the order of magnitude of 4% to the SPIX. We have a bit exotic stock picks like Veleda, or companies with, I think, still acceptable valuations like before. But I would say that Sonova, Straumann, Tecan, although these are all fantastic and well-run companies, we are very underweight. We think those valuations are high. They are not completely defensive. And we think that the risk rewards for the likes of Sulzer and Burkhardt is much more attractive in the present environment. In terms of sector exposures, you can see this overweight in industry, which is actually industrial, sorry, which is also due to all the tech industrials we have in there. IT tech is formally neutral. We still don't have any Temenos. We're a bit underweight financials, as we have few insurance exposure, and we are underweight healthcare. The cash actually is a working cash of 3%. We consider to be fully invested. Now, ESG is an important factor for Bellevue. It's important that we work within this framework. We consider it as stock pickers as a way to potentially discover and preempt interesting companies which are not valued yet at their fair rating. We all know, so Bellevue works with MSCI. It's a big provider. They have a big databases, but it's prone to inefficient ratings. So we hear from many companies which complain about a tick the box exercise. They are rated once a year, and we think it's interesting both to it's necessary to implement this in the due diligence. And it's also necessary and useful to be able to sort of estimate what the ESG changes in the company and in the rating will be. We have few companies which are not rated, even like Compagnie Financière Tradition, Veleda, or Pira. But we also have companies which are still rated poorly, from B to BBB. And we think this is a potential. And as we know the companies well, we talk to the management, and also the managements have understood at board level, at CEO, CFO level, that sustainability is not just something you discuss at the end of a conversation, but it's something which is high up the agenda, and which will determine future performance and future valuation. So with this, I'm closing for today's updates, and over to you, Sandro.
Thank you very much for the interesting update, Birgitte. I can well imagine that this has confirmed our investors in their position and hopefully also highlighted some opportunities. On behalf of Bellevue Asset Management, I would like to thank you very much for your trust, and should you have any questions, your personal contact will be happy to answer them. In this spirit, I'm wishing you a successful business day and stay healthy. Auf Wiedersehen.